Hi, welcome back to our YouTube channel. My name's Dan, I'm Managing Director here at Riverview Portfolio, your added value accountants. This video is about the new corporation tax rates which came into force for limited companies from the 1st of April 2023. Understandably, when there's any changes to rates, it's triggered lots of questions. So I hope you find this video useful, and we're just going to go through some of the key points that have come up with questions that have been asked of us over the past few months. Most notably, the corporation tax headline rate is moving from 19% to 25%. But that won't affect every company because this is going to be on a phased profit approach for people earning between £50,000 of taxable profit up to £250,000 of taxable profit. For companies that have a year end that straddle this change, so say from coming in from the 1st of April, you'll actually have a bit of a hybrid rate. So what that means is that there'll be a straight line apportionment of your profits in that period. So let's say, for example, you've got a year end of 30th of September 23. So you've got 6 months that fall under the old regime and 6 months that fall under the new one. Effectively, if you made £100,000 profit in that period, £50,000 or half of that for the 6 months of that year will fall under the old regime, and the other half will fall under the new one. So you'll end up with a bit of a hybrid rate of tax. Therefore, it's important to make sure that when you've purchased new things, the allocations of assets and so on, super deduction that was also in place up to the 31st of March, you get those things allocated correctly so that you manage that tax position in the best way possible. Most notably, with people that are earning less than £50,000 worth of taxable profit, your rate of corporation tax will stay exactly the same, and it will still be at 19%. Where companies will start to be affected by the increase that has come into effect is where your taxable profits exceed 50,000. Between 50 and 250, effectively you're going to have a sliding scale of what that corporation tax rate will be. i.e., the further that you're past £50,000 worth of taxable profit, the higher rate of corporation tax that will be calculated. Therefore, it's really, really important in terms of managing the impact of this, because companies that are earning over £250,000 of taxable profit, all of your profit will be taxable at 25%. Therefore, making sure that you're reporting the right profit, but also using things that can help to reduce what your taxable profit is in the right ways becomes even more important than it has ever been with this increase. A 6% increase across anything is a painful one to swallow, and therefore it needs to be managed. The added complication that comes with this changes that have come into effect from 1st of April is also where people have more than one business. So imagine that you've got a group of companies. Effectively, under corporation tax rules, they now become what's known as associated. And these thresholds will now be adjusted based on the number of associated companies. This can also be the case where you've got companies that are under common ownership. So where you've got more than one company, you're now not looking at your rate in isolation. So this is really, really important, again, in your planning around how you structure your business and its activities to make sure that you manage this in the best way possible. With the increase to this rate, it's therefore really, really important to look at things that can help you be tax efficient as possible. Some really, really key areas, this is not an exhaustive list, but ones where we see commonly where people can make sure that they're utilising those allowances that are available, are around R&D, so research and development tax credits. Does that apply to your business? The common misconception is that it only applies to IT software companies or pharmaceuticals. Actually, it's a much wider tax credit relief available to many other businesses depending on what their activity is. You've then also got capital allowances. So although super deduction is no longer applicable, still making sure that you allocate your asset purchases or timing of it to maximise things like the annual investment allowance or the fully expensed capital allowance that is now referred to is really, really important. And finally, pension contributions. So again, timing around pension contributions can help manage the impact of that and using the excess cash that's within your business to again help benefit you in the future as a company owner, but also to help manage that tax burden in the short term as well. If you're unsure about the impact of these changes to you and your business, please feel free to reach out to us and we'd be happy to discuss how this all interacts and how we can best help you with it. Thanks for watching this video. We hope you found it useful. If you did, please give it a like, subscribe to the channel and share with others. Likewise, if there are any other topics that you want us to cover off, please do let us know, because we'd always be happy to do more of these videos if you find them useful. Thanks again for watching. See you next time.